This is really fascinating to me, Bob. And I think a lot of our viewers and subscribers to our YouTube channel have seen this before. I've made a video on this. This chart actually supports your overall bearish case. Now, this is a Benner cycle, as I'm sure you know, Bob. Samuel Benner devised this cycle back in the late 19th century. And a lot of his calls actually back in over 100 years ago were correct. He called the 1930s Great Depression. Just he got it wrong by about a year or two, but essentially he was right, as you can see, 1927. The market crash top occurred in 1929. 1945, 1965, these are all correct. The biggest one to me that's interesting is the dot-com crash he was absolutely correct about. By the way, these years, Samuel Benner said these mean the completion of the years, not the beginning. So when we see these years, I just want to make sure our YouTube viewers know this, the years do not mean the beginning of those years, it means the end. So, for example, he called the end of 1999 being the top, very close to the dot-com bubble crash, which lasted all the way to the 2000s, early 2000s, and the 2007. Yeah, there it is right there. The 2007 top, which then dropped and crashed. That was, of course, the Great Recession, as we know. And the end of 2019, that would be the COVID one. But you can see here, according to his cycle, 2026, the end of 2026 is his view, was his cycle top for the stock market. By the way, it could be a year or two off. But I think this is interesting because this goes along with your expectation too. A top in 2026 or maybe the end of 2026 to then last all the way, as we can see there, the bottom is the 2032. Early 2030s. Do you have any thoughts on this? I just find this amusing. I mean, it's okay if you don't have anything to say about it, but I just wondering if you have any thoughts on it.
Sure. In the back in 1978, A.J. Frost did a version of this very chart.
Really?
He called it the Benner Fibonacci chart because he found he offset it slightly to fit certain Fibonacci periods.
Yeah.
Now you can also look at this chart and look at the major bottom in 1985. Well, that was off by 3 years.
It was, yeah.
At the same time, in September 85, I remember like it was yesterday, I was the only bullish advisor in September 85 in the market vein tally. I thought it was a series of ones and twos on the upside. Mm-hmm. And everybody else was saying, oh, it looks toppy, or it's blah, blah, blah. I said, no, man, this is getting ready to go vertical on the upside. Like I said, all the advisors were extremely bearish at that time. So Benner kind of had it right in a way. People were still really, really negative in September of 1985. And then the market absolutely took off on the upside. Yeah. So and if you look at the 2012 low, that was off by 3 years as well. Because
it was, yeah.
Bottom in 09. But as I mentioned in our earlier discussion, that was also the low in real estate was in 2011, 2012. The low in Dow Gold was in 2011 as well, and kind of stayed around that area until late 2012. That's when gold topped out. And we said at the time, last chance to sell your gold. So everything is counterintuitive. Yeah. I think this Benner thing is pretty interesting, but I would not bet all my money.
Sure.
In 26, maybe we top in 2024 and we do a 1 down and a 2 up for wave A in 2026, and that's when the real crash happens. I mean, all kinds of possibilities when you study the Benner chart and what happened in reality. Yeah. I still say all my toys are in the front yard. You can play with them. I'm not going to play. I'm not going to play. I couldn't be less interested in owning a single share of stock. And in fact, I think if you're bold, you should every now and then be betting on the downside when things are extreme on a short-term basis, on a 5-day basis or something like that. So even though you've got, numbers up at 20, 2 years from now is a likely top, I'm just going to stick with saying, we're bearish right now. It's hard to say because as I said earlier, we are dealing with a measuring unit that's completely elastic. And if they screw up the measuring unit, it may never see those low levels. Now, in real terms, it's going to get there. It's already there. It's not at 3,000. It's at 300. So if we stayed on the gold standard, the Dow would be currently 300, and everybody would know we've never had a bull market, or certainly since 1999 when the Dow gold ratio topped out. So, when you say, could it go to these numbers? Well, yeah, but unfortunately, we've got human beings with their hand on a throttle that can say, well, let's make a few more trillion of these things. Let's make a quadrillion of them. We don't care. And then, of course, they'd say, well, it never got to 6,000. I'd say, yeah, well, it really did. You just couldn't see it. When, I don't think it's an if, I think it's when we get our debt implosion and junk bonds go to zero, and many corporations are going to go out of business. A lot of stocks are going to go to zero. We're going to have a debt implosion at that time. And I think even in dollar terms, we will have a significant history-making fall in stock prices.
Where we are now, where are we in the big picture from 1800s? There is a 1929 crash and then 1932 low, and there we are. My view is that we could potentially top, if not this year, then next year or 2026. But you're more expecting. I think your view is that we're already in the very final stages, right there in the final wave 5, right there. So
yeah, right or wrong, and
yeah,
we've felt it for a while. We think we're right at the top.
I think that's a very good point about a big A wave down, like it happened in the 1929 Wall Street crash, October 1929. Big move down in the A wave, then a fake rally in a B wave fake rally, which gets everyone bullish again, and then boom, C wave, very deep, very devastating and painful C wave